Hello, fellow travelers. My name is Martin Desmond. I was visiting one of our relatives this summer when we got into a discussion about Tesla. We claimed that Tesla, which has a current market capitalization of $1 trillion, would hit a market cap of $2 trillion in the near future because of the brilliance of Elon Musk. Now, my relative probably has 20 times the net worth that I have and has made far more money on the stock market than my rather small IRA. While he was talking, I looked up the price earnings ratio of Tesla, which was 180 to 1. As I make this video at the end of August 2025, Tesla has a market cap of 208 to 1. When I mentioned the absurdly high PE ratio of 180 to 1, he said that did not matter and that Tesla's market cap would double to $2 trillion. Based upon each of our personal track records, my relative has certainly outperformed me. For those of you who are not familiar with the price earnings ratio, it's a fairly simple ratio to understand. The price of the stock is listed as the numerator, and the earnings per share of the stock is placed in the denominator. In this example, the price of the stock is $100. The earnings per share is $10. Therefore, the price earnings ratio is 10 to 1. One of the more well-known price earnings ratios is called the Shiller ratio. The price earnings ratio of Shiller currently hovers around 39 to 1, which is near an all-time high. Another famous ratio is the Warren Buffett market capitalization over gross domestic product ratio. The ratio is currently at 213%, which is a record high. In this video, I'm going to compare 4 of the Mag 7 stocks with 3 of the gold mining companies in regards to the price earnings ratio. While my relative will disagree, price earnings ratios do provide one way to analyze the performance of stocks. Certainly, there are a number of other financial factors that need to be analyzed, but for the sake of simplicity of this 9-minute video, I'm just going to look at the PE ratio. I'm going to assume that all of you know Google, Apple, Nvidia, and Tesla, so I'm not going to describe any of these companies. The 3 gold mining companies are Newmont, Agnico Eagle, and Barrick. Newmont is the largest gold producer and the only gold mining company in the S&P 500. Barrick used to be the second largest gold producer, while Agnico Eagle is an up-and-coming gold producer and will likely become the second largest producer in the next several years. For those of you who are not familiar with analyzing gold-producing companies, one of the primary financial tools is to examine what is called the all-in sustaining costs. All-in sustaining costs in gold mining refer to the total production costs incurred to finance the ongoing operations of a mine, including cash costs, sustaining capital, depreciation, mine reclamation, and other related expenses. It provides a comprehensive measure of the cost to produce an ounce of gold, helping investors assess the mine's profitability and economic sustainability. Gold has certainly been moving up in price over 37% in the last year, although the price has stabilized during the summertime in the range of 3,300 to 3,400. This particular chart shows the price of the gold ETF, which mirrors the spot price of gold. Let's take a look at the second quarter all-in sustaining costs for each of these 3 gold mining companies. Publicly traded companies typically issue a new corporate presentation each quarter. Newmont has an AISC of 1620 for 2025. Newmont has had a $3,320 average gold price received for 2025. Simple math shows a net profit of $1,700 for each ounce of gold produced. We can wander into the free cash flow of 1.7 billion and earnings before interest, taxes, depreciation of 3 billion. As Peter Schiff of Pacific Capital has written, Newmont is printing cash. As of the end of August 2025, Newmont has a 13 to 1 PE ratio. Barrick has an AISC of 1640 for second quarter 2025. We can look into the free cash flow of $395 million and earnings before interest, taxes, depreciation of $1.6 billion. The net earnings per share has grown from 21 cents in quarter 2024 to 47 cents in quarter 2025, more than doubling from the previous quarter a year ago. At the end of August 2025, Barrick has a 16.4 to 1 ratio. Agnico Eagle has an even more impressive set of numbers. The second quarter of 2025 has a surprisingly low AISC of $1,289 per ounce. Agnico Eagle has a realized gold price of $3,288 for the second quarter 2025. As you can see on the company's second quarter presentation results, the company has generated 1.3 billion of free cash flow. The net earnings per share is $2.13, more than double the net earnings per share of 95 cents in the second quarter 2024. At the end of 2025, Agnico Eagle had a 23 to 1 PE ratio. Well, let's look at the four MAG stocks performed against the three gold mining companies in 2025. Let's look at the PE ratios of the seven companies. Newmont easily takes first place with the lowest PE ratio of 13. The second place we have Barrick. This next chart substitutes Tesla with Shiller PE ratio of 39. Keep in mind that Shiller's PE ratio is near an all-time high. The gold mining companies are all very comfortably below the Shiller ratio. Nvidia is well above the Shiller ratio, while Apple is nearing the high Shiller ratio. As a disclosure, I do own stock in the three gold mining companies, but the amount of money is so small that if I were to sell all the stocks at the same time, there would not even be a blip of a blip. Here is the 2025 year-to-date earning percentage increase of the four MAG companies and the three gold mining companies. The big winner for the first 8 months of the year is Newmont, which has increased in value by over 90%. AEM and Barrick show impressive gains of over 60%. Of the four Mag 7 companies, Nvidia has the best record with a 29% increase for 2025. Google clocks in at a respectable 12%, while the two laggards, Apple shows a 7% loss and Tesla shows a 17% loss. The big question is whether the stock market will continue to the long-term average PE ratio somewhere in the range of 15 to 1. As many commentators have noted, stocks can stay out of balance for much longer than you would expect. Thanks for listening to the end. Please hit the like and subscribe button.